confuse us if we're being honest here. I'm your host, Ben the Bull, aka Max Pitts, and today we're diving into May's retail sales report, aka the economic mood ring of America. Spoiler alert, sales dropped like a meme stock after earnings, and Wall Street definitely noticed. So let's go ahead and talk numbers. Headline retail sales came in down 0.9%. Mind you, we were expecting down 0.6%. And this is also, that is from the previous plus 0.2% that was reported. So we had a 0.8% expectation with a huge swing in the wrong direction with that. April was revised lower to minus 0.1%, double ouch. X autos is down 0.3%. Core sales, X autos, gas, food, and building materials up 0.4%, aka the GDP driver, folks. Now, why the drop? Americans rushed to buy cars in March to dodge Trump's 25% auto tariffs. By May, that sugar high was over. Car sales tanked down 3.5%, dragging the entire report down. Restaurants, home and garden, electronics, they all saw declines. Apparently, no one wants a Big Mac or a lawnmower anymore. Now, the consumer front loaded in March. They basically said, let's buy that car now before the price goes nuclear. But now, the hangover. And Trump's tariffs are starting to bite. Consumer confidence is shaky at best. Businesses aren't hiring like they used to. And the White House have dialed back some of the trade war talk, but the vibes are still very recession adjacent. But not everything is doom and gloom, folks. Online sales up 0.9%. Furniture stores up 1.2%. Apparently people are nesting. Clothing stores up 0.8%. Retail therapy is still real. And the gas prices dropped, which is good for wallets, even if it messes with top line sales. Now let's go ahead and peek under the hood here. We saw XRT, a retail ETF, put to call ratio spike to 1.6 on Monday. Bearish flow from institutions. We saw TSCO and WMT, Walmart, heavy out of the money put buying. Meanwhile, a $15 million call sweep hit Amazon. Someone thinks e-commerce eats brick and mortar's lunch. Dark pool prints flagged Costco with multiple $10 million blocks. Quiet accumulation, or just Costco preparing for a bulk buy of inflation hedges. So what does this mean for the economy exactly? Consumer spending equals 2/3 of our GDP. Just keep that in mind. If retail slows down, so does the whole machine at this point. Morgan Stanley says we might see a consumption slowdown through year end. Why? Inflation could spike again. Labor market is softening. No more stimulus checks. And don't forget, student loan repayments are back and back, bigger than ever. The Fed is watching this like a hawk or a dove pretending to be a hawk. Looking ahead, Powell and the Fed are mid-meeting this week. Dot plot is coming in hot. Will they hint at rate cuts maybe? Or when those are actually going to be delivered? And the markets want dovish, but they may get a shrug instead. If the data keeps slowing, expect bond yields to drop, rate cut bets to rise, and risk on assets to rip. But if inflation rebounds, rug pull season, baby. Now, our verdict. Retail sales stalling isn't the end of the world, but it is a warning shot. Options flow says smart money is hedging for a chop. Watch energy prices, watch Powell's tone, and track consumer confidence. The playbook we're looking at here is to stay nimble, don't chase breakouts blindly, and know when to sit out. Cash is a position, folks. That's it for today's retail sales recap. If you learned something or just like the sarcasm, smash that like button, subscribe, and drop a comment below. Where do you see the consumer heading? 4, setups, premium analysis in our real-time trade tracker. Check out Investor Central Club. We do the work, you catch the gains. Until next time, trade smart, stay snarky, and may your options never expire worthless. Out.